The banks smashed the paper price to $61.96. They want you to believe the rally is over. They want you to believe that silver is just a speculative bubble that just popped. They are lying to you, and not just a little lie. This is a lie of omission, so massive it borders on criminal negligence. While you were staring at the comic sticker yesterday, while the algorithms were dumping paper contracts in New York, something happened in South Korea that makes the price of silver irrelevant. Something happened that changes the fundamental chemistry of the global energy transition. Samsung SDI, one of the largest battery manufacturers on the planet, just quietly confirmed the specifications for their new solid-state production line. The media is calling it a battery breakthrough. They are talking about 900-mile range and 9-minute charging, but they are missing the single most important detail, the detail that Wall Street hasn't priced in, the detail that the mining companies haven't prepared for, the detail that makes 1.1 billion ounces of deficit look like a rounding error. The secret ingredient in Samsung's new battery isn't lithium, it isn't cobalt, it isn't nickel, it is silver. And not just a trace amount. We are talking about a massive structural increase in silver consumption per vehicle. We are talking about a technology that moves silver from being a precious metal to a strategic energy metal. In this 4-part deep dive, I am going to expose the silver bomb that Samsung just dropped on the global supply chain. I am going to walk you through the chemistry of the silver-carbon anode. I am going to do the math that the IEA refuses to publish, the math that proves there isn't enough silver on Earth to electrify the fleet using this technology. And I am going to show you why Friday's price drop to 62 wasn't a crash. It was the last chance you will ever have to buy silver before the auto industry realizes they have made a fatal calculation. The banks are playing a paper game. Samsung is playing a physics game. Physics always wins. This is the story of the silver-carbon revolution. To understand why this news is an extinction-level event for silver supply, you have to understand a little bit of chemistry. Don't worry, I'll keep it simple. For 30 years, the world has run on lithium-ion batteries. Your phone, your laptop, the Tesla Model Y in your driveway. They all use liquid electrolyte lithium-ion batteries. They are great, but they have a fatal flaw. It's called the dendrite. When you charge a lithium battery fast, or when you charge it too many times, the lithium ions form these little needle-like crystals called dendrites. They grow like jagged roots inside the battery. Eventually, they pierce the separator, the wall between the anode and the cathode. When that happens, boom, short circuit, thermal runaway. Fire. This is why EVs take 45 minutes to charge. You have to charge them slowly to prevent dendrites. This is why they catch fire. This is why they lose range in the winter. The holy grail has always been the solid-state battery, a battery with no liquid, no fire risk, instant charging, double the range. Every company from Toyota to Volkswagen has been promising this for a decade, but they all failed. Why? Because they couldn't stop the dendrites from forming on the anode. Graphite anodes didn't work. Silicon anodes expanded too much. Pure lithium metal anodes were too unstable. Then the researchers at Samsung SDI found the solution. They discovered that one specific element, when applied as a nanocomposite layer, completely solved the problem. It allowed the lithium ions to move freely, but it stopped the dendrites cold. It was stable. It was conductive. It was perfect. That element is silver, specifically a silver-carbon nanocomposite layer. This isn't a theory. This is published science. Samsung's prototype cells use a thin layer of silver mixed with carbon to regulate the deposition of lithium. The silver acts as a host for the lithium ions. It dissolves them evenly, preventing the spikes from forming. This allows the battery to be smaller, lighter, faster, and safer. But there is a catch. A massive catch. To make this battery work, you need silver, and you don't need micrograms of it. You need grams of it. For the first time in history, silver is not just being used for its conductivity. It is being used as an active material in the electrochemical storage process. It is becoming part of the battery's DNA, and the auto industry is about to scale this technology to millions of cars. Do you see the problem yet? You might be thinking, okay, so they use a little silver, so what? Cars already use silver. Let's context this. Right now, a standard combustion car uses about 15 to 20 grams of silver. It's in the window switches, the seat motors, the defrosters, the ECU. An electric vehicle uses more, about 30 to 50 grams. It's in the inverters, the battery management system, the high-voltage cables. This EV bump is already draining the market. It's part of the reason we have a 1.1 billion ounce deficit. But the solid-state battery changes the math entirely. We aren't talking about switches anymore. We are talking about coating the anode of every single cell in a 1000 pounds battery pack. Early estimates from the Samsung papers suggest the silver loading could be anywhere from 5 grams to 10 grams per kilogram of anode material. Some aggressive estimates suggest it could be as high as 0.5 to 1 kilogram of silver per vehicle for high-performance, long-range packs. Let's be conservative, extremely conservative. Let's assume it adds just 50 grams of silver per car. That brings the total silver per EV to roughly 100 grams. There are 90 million cars produced globally every year. If just 10% of them switch to solid-state batteries, that is 9 million cars. 9 million cars times 100 grams is 900 million grams. That is roughly 29 million ounces of new silver demand. That sounds manageable, right? But that's a 10% adoption with conservative numbers. What if it's 50% adoption? What if the silver loading is actually 200 grams per car? If Toyota, Samsung and Volkswagen hit their targets of mass-producing solid-state EVs by 2027-2028, we could see automotive demand for silver jump from 90 million ounces a year to 200 or 300 million ounces a year. Where does that 200 million ounces come from? Does it come from the COMEX? The COMEX only has 30 million ounces left and registered. Does it come from the miners? Global mining is flat at 830 million ounces. This single technology, the silver-carbon anode, has the potential to consume 25% to 35% of the entire global mine supply just for car batteries. That leaves zero silver for solar panels, zero silver for electronics, zero silver for jewelry, zero silver for you, and Samsung just confirmed they are building the pilot line. The timeline has accelerated. This isn't a 2035 story. This is a right now story. While the banks were smashing the price to $61.5 on Friday, Samsung procurement officers were likely locking in long-term supply contracts with miners. They know the math. They know that if they don't secure the silver, their billion-dollar battery factories are worthless. This shift represents a fundamental change in the nature of demand. In the past, silver was an industrial spice. You sprinkled a little bit on a circuit board. You put a tiny bit in a light switch. Because the amount was so small, the price didn't matter. If silver went from $20 to $100, the cost of the iPhone only went up by 50 cents. Apple didn't care, but with solid-state batteries, silver becomes structural. It becomes a major line item in the bill of materials. If a battery pack requires 500 grams of silver at $60 an ounce, that's $1,000 worth of silver in every car. This terrifies the auto manufacturers. They operate on razor-thin margins. A $600 cost increase per vehicle destroys their profit. So what is their strategy? Thrifting. They will try to use less silver. They will try to engineer it out. They will try to use silver-coated carbon instead of pure silver powder. But here's the problem. Chemistry is stubborn. You cannot cheat the electron. If you reduce the silver, the dendrites come back. If the dendrites come back, the car catches fire. Would you buy a silver light battery if you knew it had a 5% chance of exploding? In your garage? No, Samsung knows this. Toyota knows this. They cannot thrift the silver out without sacrificing safety. So they are stuck. They are hostage to the periodic table. This makes the demand inelastic. We talked about this with solar panels. Now we are seeing it with EVs. Two massive global industries, energy and transportation, are simultaneously pivoting to technologies that require massive amounts of silver. And they are colliding with a supply chain that has been starved of capital for a decade. Friday's price drop to $61.5 is laughable in this context. We are looking at a future where silver is as critical to the economy as oil. Imagine if the world ran out of oil and the price dropped to $2. Would you panic, sell your gas? Or would you fill up every tank you own? Why aren't you hearing about this on CNBC? Why is Bloomberg talking about lithium oversupply but ignoring the silver squeeze? Because the narrative hasn't caught up to the lab? Wall Street analysts are lazy. They look at spreadsheets from 2020. They assume EVs equal lithium plus nickel. They treat silver as a legacy metal used in mirrors and spoons. They don't read the Samsung SDI technical white papers. They don't look at the patent filings from QuantumScape and Toyota. If they did, they would see the word ag appearing over and over again. This information asymmetry is your edge. Right now, on this Saturday morning, the market is mispricing silver because it thinks demand is linear. It thinks demand will grow 2% a year. It doesn't. See the step function change that solid-state batteries represent. The same thing happened with palladium in the early 2000s. Auto companies switched to palladium for catalytic converters. Nobody paid attention. Then suddenly demand exploded. Palladium went from $200 to $3,000. The analysts were 10 years late. We are seeing the exact same setup with silver. The silver bomb has been detonated in the R&D labs. The shockwave hasn't hit the price chart yet, but it's coming. When Samsung officially launches the first mass-market car with this battery, when they publish the specs and the world realizes there are 20 ounces of silver in a single luxury sedan, the panic buying won't come from Reddit. It will come from Ford, GM, and BMW, and they won't be buying at $61.5. So we have established the technology, the silver-carbon anode is real, it is superior. And it is coming. But now we have to answer the terrifying question. Is there enough silver if every car company switches to this tech? If solar keeps growing? If investment demand continues, do the numbers add up? In part 2 of this deep dive, I'm going to run the math of extinction. I'm going to calculate exactly how fast the global reserves hit zero under the Samsung scenario. I'm going to show you why the recycling myth won't save us, and I am going to compare this setup to the 1980 spike to show you why 100 silver is actually a conservative target. Friday's drop was a gift. It was the system giving you one last chance to front-run the biggest industrial shift in history. The banks are looking at the weekly chart. You need to be looking at the periodic table. Don't go anywhere. The math gets scary in part 2. If you just watched part 1, you now know the secret that Wall Street is ignoring. You know that solid-state battery revolution isn't powered by lithium alone. It is powered by a silver-carbon anode. You know that Samsung and Toyota are preparing to inject massive amounts of silver into the automotive supply chain to solve the dendrite problem and prevent fires. Now we have to look at the consequences. It is one thing to say demand will go up. It is another thing to look at the geological reality of planet Earth and realize we literally cannot do this. In part 2, we are going to do the math that the IEA is too afraid to publish. We are going to run the extinction equation. We are going to look at the recycling myth and why it won't save us. And we are going to explain why Friday's price of $61.5 is mathematically impossible to sustain in a world where cars eat silver. This is where the rubber meets the road, or rather, where the silver meets the anode. Let's start with the base case. The world as it exists today before the Samsung silver bomb fully explodes. Total global mine supply 830 million ounces per year. Recycling supply 180 million ounces per year. Total supply 1 billion ounces. Now let's look at demand before solid-state batteries take over. Industrial demand, solar, electronics, 600 million ounces. Jewelry and silverware, 200 million ounces. Investment, coins and bars, 250 million ounces. We are already in a deficit. We are burning roughly 50 to 100 million ounces of reserves every year just to keep the lights on. Now introduce the Samsung scenario. Let's assume a moderate adoption of solid-state batteries. Let's say by 2028, 20% of new EVs use this technology. And let's assume a conservative silver loading of 50 grams per vehicle, global car production under 90 million units, EV market share 40%, 36 million EVs, 20% of EVs use SPS equals 7.2 million cars. 7.2 million cars times 1.6 ounces equals 11.5 million ounces. Okay, 11.5 million ounces. That hurts, but it doesn't break the world. But wait, that assumes a tiny efficient car. What about a Ford F-150 Lightning? What about a Cybertruck? Those batteries are massive. They don't use 50 grams, they might use 500 grams. If the average silver loading across the fleet is closer to 200 grams, and if adoption hits 50% of EVs, let's rerun the numbers. 18 million cars times 6.4 ounces equals 115 million ounces. 115 million ounces of new demand, that is more than the entire annual production of Peru, that is equivalent to another solar industry appearing overnight. Where does that 115 million ounces come from? The market is already in deficit, the vaults are already empty. There are only two places it can come from. Number one, price destruction. The price goes so high that people stop buying jewelry and silverware. Number two, investment cannibalization. The price goes so high that you sell your coins to Samsung. This is the extinction equation. Total supply is less than solar plus electronics plus solid-state batteries. We aren't even counting investment demand anymore. The industrial demand alone threatens to consume 100% of the mine supply. If that happens, silver ceases to be a monetary metal available to the public. It becomes a critical strategic material reserved for industry. You won't be able to buy it. it will be unobtainium. But wait, the skeptics scream, we will just recycle, we will take the old silver out of old cars. This is the recycling myth, and it is dangerous because it gives politicians a false sense of security. Here's the reality of silver recycling. Gold is recycled at a rate of nearly 90%. Why? Because it's concentrated. Silver is recycled at a rate of less than 20%. Why? Dispersion. Silver is the vampire dust of industry. It is sprinkled in microscopic amounts across billions of devices. There is 0.1 grams in your phone. There is 0.5 grams in your laptop. There is a thin film in a solar panel. There is a nanolayer in a missile guidance chip. It costs more energy and money to extract that silver than the silver is worth. So it goes to the landfill. We are literally burying billions of ounces of silver back into the earth, but in a form that is impossible to mine. Now consider the solid-state battery. Yes, it has more silver, but do you recycle a car battery next year? No, you recycle it in 15 years. The silver that goes into a Samsung solid-state battery in 2026 is locked away until 2041. It is removed from the supply pool for a generation. So the recycling wave that everyone is hoping for, it won't arrive in time to save us from the shortage of the 2020s. The deficit is structural. The consumption is destructive. The sequestration is long-term. This means the only solution to the Samsung scenario is more mining. But can we just dig more? If silver hits $100, surely the miners will flood the market with supply, right? Wrong. This is the geological wall. You cannot print a silver mine. It takes roughly 10 to 15 years to take a mine from discovery to production. If we found a massive deposit today, it wouldn't produce a single ounce until 2035. But Samsung needs the silver now. Tesla needs the silver now, and the existing mines, they are dying. The ore grade has collapsed. In 2005, a good mine had 15 ounces per ton. Today, a good mine has 4 ounces per ton. We have to dig up for X more rock to get the same amount of silver. That requires more diesel, more water, more labor. It is getting exponentially harder and more expensive to mine. And let's talk about politics. Mexico produces 25% of the world's silver. The Mexican government has stopped issuing new open-pit mining permits. Peru is constantly facing strikes and protests. Russia is sanctioned, so precisely at the moment when the silver-carbon anode is demanding 100 million new ounces. The global mining supply is threatening to shrink. This is a pincer movement. Demand is exploding, supply is collapsing, and the inventory buffer is gone. There is no relief valve. There is no elasticity. The only thing that can give is the price. This leads to a fascinating paradox. The EV paradox. Governments around the world have mandated the end of the internal combustion engine. They have legally forced the transition to EVs. They are subsidizing battery factories, but they forgot to check the periodic table. If silver goes to $200 an ounce, the cost of the solid-state battery skyrockets. The EV becomes unaffordable for the average person. The transition stalls. But the governments cannot let the transition stall. They have bet their political reputations on net zero. So what will they do? They will subsidize the silver, or they will seize the silver. We talked about the Defense Production Act in previous videos. This is where it becomes real. If GM tells the White House, we can't build the cars you mandated because we can't get silver, the White House doesn't say, okay, forget the cars. The White House says, we will get you the silver. They will declare silver a critical strategic material. They will prioritize industrial allocation over retail investment. They might ban the sale of silver eagles to the public to divert that metal to the battery factories. This is the nightmare scenario for the stacker who didn't buy yet. You won't be competing with a high price. You will be competing with a government mandate. Samsung isn't just a company. In South Korea, it is the economy. The South Korean government will move heaven and earth to ensure Samsung has silver. The US government will do the same for Tesla. The silver-carbon anode makes silver a matter of national security, and national security always trumps the free market. So we have the tech, we have the math. The conclusion is undeniable, structural and solvable shortage. But how do you profit from this? Friday's drop to $61.5 has scared a lot of weak hands. But if you understand the Samsung scenario, you realize that $61.5 is a joke. It is a pricing error. In part 3, we are going to pivot to the solution. I am going to show you which mining stocks are best positioned to leverage this new demand. I am going to explain why numismatics might be a trap. And I am going to give you the exit strategy for when this mania truly hits. The tech is real. The shortage is real. The Friday dip is fake. Don't let them shake you out. The revolution is just getting started. If you have watched part 1 and part 2, you now possess information that 99% of Wall Street is ignoring. You know that the solid-state battery revolution requires a silver-carbon anode. You know that this single technology could consume 115 million ounces of new silver annually, and you know that the geological wall means mines cannot expand fast enough to meet this demand. So here we are, Saturday, December 13th, silver closed yesterday at $61.5. The market is fearful, the retail investors are panicked, but you are calm. Because you know that this price drop is a glitch in the matrix. It is a temporary mispricing before the reality of the Samsung scenario hits the ticker. But knowledge without action is useless. How do you position yourself to profit from this silver bomb? Do you just buy coins? Do you buy miners? Do you buy ETFs? In part 3, I'm going to give you the strategic playbook. I am going to break down the 3 lanes of the silver trade. I'm going to expose the trap of semi-numismatics during an industrial squeeze, and I am going to show you why the unhedged miner is the only stock you should own right now. The auto industry is about to panic buy. You need to front-run them. Here is how. Lane 1, physical. Metal. This is your insurance policy. This is your wealth preservation. But in an industrial squeeze, the rules of what to buy change completely. For years, dealers have pushed semi-numismatics, collectible coins, limited edition prints, Star Wars silver. They told you these hold value better, and in a normal market, maybe they do. But we are not in a normal market. We are entering an industrial vacuum. When Samsung needs silver for a battery, they do not care if it has a picture of Darth Vader on it. They do not care if it is an Ms. 70 graded coin. They care about one thing, the atom. They need raw silver to melt down into nanopowder for anodes. This means that in a true shortage, the premium on collectibles collapses relative to the spot price. Why? Because the industrial buyer sets the floor. If spot goes to $100, the melt value of your coin is 100. But nobody is going to pay you 150 for the collectibility when the world is starving for the metal itself. The strategy: stop paying for art, start paying for weight. In the Samsung scenario, ounces matter most. A 100-ounce industrial bar is the superior asset. Why? Number 1, lower premium. You get more silver for your dollar today. Number 2, liquidity. If you need to sell to an industrial buyer or a refiner, they want bars. Number 3, density. It is easier to store 1,000 ounces in bars than 1,000 ounces in tubes of coins. If you are buying right now at $61.5, ignore the fancy stuff. Buy the cheapest, most recognizable government or corporate bullion you can find. Maples, Eagles, 100 bars, 10 bars. Your goal is to accumulate the maximum number of grams of silver before Samsung clears the shelf. Lane 2, the mining stocks. This is where life-changing wealth is made if you pick the right horse. I mentioned that miners are the strategic reserve, but there is a trap here too. It is called the hedging book. Imagine a mining company called Loser Gold Corp. Last year, when silver was $25, they were scared. They wanted to guarantee a profit, so they signed a contract to sell 50% of their production at $30 for the next 3 years. Today, silver is $61.5. Loser Gold Corp is selling their silver for $30. The bank keeps the extra $31.5. Their stock will barely move. They missed the party. Imagine Winner Silver Inc. They believed in the shortage. They refused to hedge. They sell every single ounce at the spot price. Today they sell at $61.5. If silver goes to $100, they sell at $100. This creates operating leverage. If their cost to mine is $20 at $30 silver, they make $10 profit. At $100 silver, they make $80 profit. Price went up 3x, profit went up 8x. Their stock price will likely go up 10x or 20x. The strategy: you must audit the miners you own. Go to their quarterly reports. Look for the section hedging and derivatives. If you see forward sales, run away. You want 100% unhedged exposure, and you want primary silver miners. Most silver comes as a byproduct of lead or zinc mines. Those companies don't care about silver prices. It's just a bonus. You want a company that lives and dies by silver. The Samsung scenario creates a bidding war for these companies. Battery makers might start buying equity in miners to secure supply. If Samsung buys 10% of a junior miner, that stock goes to the moon overnight. Lane 3, geography. We touched on this, but it is critical for the battery metal narrative. The US government and the EU have passed laws that require battery materials to be sourced from friendly nations. This is to qualify for EV tax credits. If a car company buys silver from Russia or China, no tax credit. If they buy from a mine in Nevada or Ontario, huge tax credit. This creates a two-tier market for silver miners, clean silver vs dirty silver. Clean silver will trade at a premium. Samsung and Tesla will pay more for silver from a safe jurisdiction because it keeps their supply chain legal. The risk in Latin America, Mexico and Peru are the giants of silver production. But as prices rise to $100, the temptation for their governments to seize the mines becomes 100%. We are already seeing labor strikes and blockades in these regions. The strategy? Tilt your portfolio toward Tier 1 jurisdictions. Canada, USA, Australia. These countries have stable laws and critically, they are strategic allies for the battery supply chain. A mine in Idaho is worth 5x more to Tesla than a mine in Bolivia, even if the gold is the same, because the Idaho mine is secure if you own mining stocks. Check the map. If 100% of their assets are in a country with a history of seizing assets, you are holding a ticking time bomb. Finally, let's talk about the exit. I told you in the last video not to sell for fiat, but you do need to rotate out of the battery trade eventually. Technology moves fast. Right now, the silver-carbon anode is the winner. It will drive the market for the next 5 to 10 years, but in 2035, maybe they invent a graphene anode that uses no silver. Maybe they invent a sodium battery that kills lithium-ion. Commodity supercycles driven by technology usually last 7 to 10 years. Think of uranium in the 2000s. Think of cobalt in 2017. We are at year 0 of the silver battery cycle. You have a runway. The squeeze is just starting. Friday's price of $61.5 is the starting line, but you must stay vigilant. If you see headlines in 5 years saying Toyota invents silver-free solid-state battery, that is your signal. That is when the structural deficit might ease. But for the next decade, the math is locked in. Factories are being built today designed for silver. They cannot switch gears for at least 2 product cycles. So for the foreseeable future, the Samsung bid is the floor under the silver price. The strategy? Ride the S-curve, accumulate now, hold through the mania, and look to swap into land or assets when the headlines become euphoric. Do not marry the trade forever. Marry the macro, date the tech. So you have the playbook, physical bars, weight over art, unhedged miners, leverage, safe jurisdictions, security. But there's one immediate hurdle left. Sunday night, we are currently in the weekend gap. The price is frozen at $61.5. But the news about Samsung, the news about the halted refineries, the news about the failed margin nuke, it is all circulating. When the Asian markets open tomorrow night, we are going to see the market vote on Friday's drop. Will they accept the lower price? Or will they attack the shorts and gap the price back to $64? In part 4, the final chapter of this series, I'm going to give you my specific prediction for the Sunday night open. I'm going to explain the Shanghai arbitrage that forces the price higher. And I am going to leave you with a final message about the psychological warfare you will face next week. The Samsung bomb has exploded. The shockwave hits Monday. The Samsung era is here. Don't miss the conclusion. We have arrived at the conclusion. If you have been with me through this entire deep dive, you now understand the full scope of the silver bomb. You understand the technology. You understand the math. You understand the strategy. Now we stand on the precipice of a new week. It is Saturday, December 13th. The markets are closed. The price is frozen at $64.5, down from the highs, beaten down by the banks, but still holding the breakout structure. This weekend, silence is deceptive. While the Western exchanges are closed, the information is traveling. The engineers in South Korea are running calculations. The procurement officers in Germany are updating their spreadsheets. The sovereign wealth funds in the Middle East are reading the same reports I just showed you. The paper smash on Friday gave the world a discount coupon, but that coupon expires on Sunday night at 6 p.m. Eastern Time. In this final chapter, I'm going to walk you through the Sunday night open. I am going to explain the Shanghai arbitrage, the mechanism that will likely force the price back up. And I am going to leave you with a final warning about the psychological warfare you are about to endure. The Samsung bomb has exploded. The shockwave hits Monday. Here is what to expect. When the market opens on Sunday evening, all eyes will be on one number, the C premium. The Shanghai Gold Exchange is the physical heartbeat of the Asian market. Unlike the COMEX in New York, which is a paper casino, the C is a physical delivery market. If you buy on the sea, you're usually taking the metal. Right now, there's a massive disconnect. On Friday, the COMEX smashed the price to $61.5. But in China, the physical premium is exploding. Due to the solar demand and the new battery tech news, silver on the street in Shanghai is trading closer to 66 or 67. Do you see the opportunity? If you're a global trader, you see silver for sale in New York for $61.5. You see silver bid in Shanghai for $67. That is a risk-free profit of $5.5 per ounce. What do? You buy New York and sell Shanghai? This is called arbitrage, and it is the force that kills manipulation. Because to capture that profit, traders have to buy the COMEX contracts. Massive buying pressure hits the COMEX to close the gap. On Sunday night, I predict we will see this arbitrage execute violently. The Asian markets know about the Samsung battery. They are closer to the supply chain. They see the factories being built. They view the Western price drop as a gift. So here's the scenario for the open. PMST, the Globux market opens. The gap Asian algorithms detect the price disparity. The bid, they flood the market with buy orders to soak up the cheap $61.5 silver. The result, the price gaps up. It might jump instantly to $63 or $64. If this happens, the Friday smash is negated instantly. The banks who went short on Friday will be underwater by Sunday dinner. This sets the stage for a short squeeze part 2 on Monday morning. The Shanghai arbitrage is the policeman of the market. It prevents the West from suppressing the price too far below reality. And with the Samsung news spreading, that reality just got a lot more expensive. Now I need to prepare you for the mental battle. Next week is going to be brutal. Not necessarily for the price, but for your emotions. The banks know they are in trouble. They know the Samsung narrative is taking hold. They know the vaults are empty. So their only remaining weapon is volatility. They will try to shake you out. You will see days where silver is up $3. You will see days where silver is down $3. They want to induce motion sickness. They want you to get so stressed watching the chart that you hit the sell button just to get some sleep. Do not fall for it. Remember the Samsung scenario? Does a $3 price drop change the chemistry of a solid-state battery?